the market is pricing in a rather high probability of a rate cut in March. You say that the Fed looks unlikely to be able to cut the way the markets are hoping. I don't know whether that means throughout 2024 or just that March number. Why don't you explain your position and why you feel the way you do?
Yeah, it's a great question, Tyler. So to Steve's point, he was just mentioning, let's say refinancings are coming up, okay? Let's ask ourselves what kind of businesses would be impacted from those refinancings at higher rates, okay? So let's just use commercial office as an example. Are there commercial office buildings that will not be able to go through that process? They will hand the keys back to the banks. No question about that. The only issue is there's not many employees that are tied to those businesses. They're asset-based businesses. They're not labor-based businesses. So I think the idea that the tight rates are going to restrict the U.S. economy in a major way, I think we've proven for about 18 months that that's just, to your point, what's the incentive that the Fed has? We're running very tight rates and the economy continues to churn and kind of move along. So I think the interesting part really for this whole dialogue is if tight rates can't stop the economy, should the Fed be backing off at all? Should they have uncomfortability to not be lowering rates quicker? And if you look back to the last 18 months, I think you'll see that the fool has been the one praying for lower rates. I mean, 2022 and 2023 had touches of, gosh, we're going to go to a lot lower rates. And that crowd's just been foolish for 18 months. And so when is that idea going to change? When is the idea the economy is going to have precipitous problems suddenly? When is that ideology going to change? Until that does, you can see where the bias is across really equity investors, particularly, but bond investors as well.
I guess Steve's retort might be, based on what he just said to me, is the idea that what the Fed doesn't want to do is wait too long and keep rates too high for too long, and therefore miss that window, that landing slot that leads to the so-called soft landing.
Yeah, it's a good point by Steve. You got to remember, though, the problem wasn't created by the Fed. In other words, the Fed, to Steve's point, was late to deal with it, and therefore is going to want to prove themselves, I'll say, both politically as well as from an academic and data perspective, that they're not going to do something foolish on the backside. But this is federal government largesse to the tune bigger than World War II relative to our GDP. And so it's like we've opened Pandora's box in federal spending, and the question is, how do you put that back in? Spending is very popular on the left side of the aisle and the right side of the aisle. That's not going to go away. And I'm not talking about spending like in Ukraine. I'm talking about federal transfers. I'm talking about Social Security, Medicare, Medicaid, the big spending categories where we run our biggest deficits.